In today's episode, I'll talk about two interesting stories. In the first one, I'll talk about why India's delivery giants are burning cash chasing groceries even while food delivery stays profitable. And in the second story of the day, I'll talk about how data centers are now becoming the backbone of our digital world and why India is racing to catch up over here. Welcome to the Daily Brief Show by Zerotha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy for all of us to understand, yet one level deeper as compared to your traditional news channels. I'm your host Anurag Bansal, and today is Wednesday, the 14th of May. See, two of India's biggest delivery players, which is Swiggy and Zomato, which also, by the way, now goes by the name Eternal, recently announced their latest quarterly results. Now, at first look, revenue has gone up, losses continue in the quick commerce segment, and the food delivery business is ticking along like usual. But if you look a little bit deeper than the surface, there is something a little more interesting that is coming up here. See, both of these companies are chasing growth for sure, but they are doing it in very different ways. And in the background, a new bunch of old and new players are entering the race, hoping to challenge them as well. But before I get into the strategic shifts and the competitive dynamics, let's very quickly understand some numbers. See, Eternal's revenues for the last quarter grew by a solid 60% year over year to 6,188 crore rupees. Now that definitely sounds like great news, but the profits here tell a very different story. Eternal's net profit fell very sharply, down by 78% compared to the same quarter last year to just 39 crore rupees. The reason was that a big chunk of its money is being burnt by its quick commerce arm, which is Blinkit. And Swiggy too, on the other hand, saw a very strong revenue jump because its adjusted revenue went up 44.4% year over year to 4,718 crore rupees. But its losses rose even faster than that. The company lost 1,081 crore rupees this year, which is a 95% jump from the year before this. So in very simple terms, Swiggy is still spending a lot more than it is earning, despite making more money than it ever has. And this brings me to the very core question of today's discussion. If these companies are growing their revenue so fast, why are profits looking worse? See, the short answer is that both Swiggy and Eternal are pumping a lot of money into the same problem, which is figuring out how to make instant grocery delivery or quick commerce a viable business. Now, they're basically betting quite big on it, and it is obviously costing them as well. But before I dive into quick commerce in detail, let's first take a quick look at the segment that still makes money for them, which is food delivery. See, food delivery continues to be profitable for both these players. Swiggy's food business had a gross order value or GOV of 7,347 crore rupees this quarter, which is up nearly 18% year over year. It earned an adjusted EBITDA of 212 crore rupees from food, which is about a 2.9% margin. Now, EBITDA, just by the way for your context, is just a way of measuring how much money a business is generating before you factor in interest, taxes, depreciation, and also amortization. It essentially helps us understand how efficiently the core business is running. But there is a more interesting insight over here. See, a big portion of Swiggy's food customers are actually coming from its grocery business. According to the company, about 30% of the people who started using their quick commerce arm, which is Instamart, in just the last 6 months also began ordering food from Swiggy. And that means groceries are now acting like sort of a gateway for new users for them. Even Swiggy's 10-minute food delivery option, which is called Bolt, which many people once saw as a marketing gimmick of sorts, is now starting to contribute more than 12% of its food orders. And these customers are sticking around longer as well because they have retention rates 4 to 6% higher than the platform's average retention rates. So basically, it seems like speed is not just a buzzword in this industry, it is also seeming to be working. It is bringing more orders and also sort of building some more loyalty as compared to the regular orders. Now, of course, there's still a lot of debate around how freshly the food delivered in 10 minutes really is, and also about driver safety, etc. But clearly, for every 1 out of 10 users on Swiggy, it is fresh enough to order for sure. But that said, what is interesting is that Eternal has taken a very different approach here. It has shut down its own versions of this quick food delivery model. CEO Dipinder Goyal was upfront about this decision, and he said that these services just could not make money without really compromising for customer experience. Now, that is a pretty honest admission, but there is also a twist to this. See, while Zomato may have pulled out of this space directly, Blinkit, which is its subsidiary, is quietly testing something called Bistro, which is a 10-minute fresh food delivery service. So the thing is, they haven't completely given up on the idea, they're just trying it through a different brand now. Now, even with this shift, Eternal's food delivery business is doing fairly well. Its GOV GOV or gross order value went up 16% year over year to 9,778 crore rupees. Revenues from food hit 2,409 crore rupees and EBITDA rose 153% to 428 crore rupees. Now these of course are strong numbers, but Dipinder Goyal also acknowledged a very big concern here, which is that food delivery is not growing like it once used to grow. There are a few reasons for that, of course. One is that people are now cutting back on non-essential spending like eating out or ordering in. Second, there are delivery worker shortages. Many of them are being absorbed by the quick commerce platforms, which are hiring very aggressively. And third is the rise of quick commerce itself, which is hurting food orders because customers are now starting to prefer packaged food delivered very fast. Eternal also, by the way, removed about 19,000 restaurants from its platform because of hygiene and trust issues, which may have further impacted all of this growth. So overall, all in all speaking, food delivery is still very profitable for them, but the real action has sort of now shifted elsewhere. The big bets and the big losses also are in quick commerce now. Swiggy's Instamart is growing fairly fast, and in just one quarter, it added 316 new dark stores, which are basically small warehouses used to fulfill quick commerce orders. Now that is more than what it added in the last 2 years put together. And with this aggressive expansion, its order volume or GOV doubled to 4,670 crore rupees. But that said, this growth came at a very big cost. Instamart's EBITDA loss for the quarter was very steep at 840 crore rupees. Swiggy CEO has tried to calm nerves by saying that this was the peak of their losses. He basically believes that the losses will now start to reduce quarter by quarter. Earlier, he had said that Instamart and the overall company would break even by October to December 2025, but now they have sort of pushed that target as much to June 2026. So profitably is basically further away than was expected. Also, one of the biggest metrics to watch in this space is AOV or average order value. Now that, for your context, is the average value of every single order that is placed on these platforms. Now for Swiggy, this metric went up 13% to 527 rupees. Now AOV, for your context, matters a lot in this business because the cost of fulfilling a single delivery, right from packaging to last mile transport, does not really change much with the size of the order. Basically, if you order 1 kg of onion or hypothetically 1 kg of onion along with a lot of other things in your cart, the amount that Swiggy or Zomato has to spend in order to fulfill your order to get it to your house does not change too much. And therefore, from a pure business point of view, it makes a lot more sense for them if we as customers spend more per order so that the average delivery cost reduces. In short, increasing AOV is one of the cleanest ways for them to improve their margins. But anyway, let's move our focus to Blinkit for a little bit now. See, they added about 294 new dark stores this quarter, which takes its total to 1,301 dark stores. Now, for your context, about 40% of these dark stores have been opened just in the last 2 quarters. So basically, they are still very new and haven't fully ramped up as such. But the growth is very, very visible here. Blinkit's GOV, which is gross order value like I mentioned, rose 134% compared to last year. Its AOV or average order value like I mentioned again came in at about 665 rupees, which though is slightly lower than the previous quarter, is still higher than what say an Instamart or Zepto have managed to bring in. Zepto, for instance, had an AOV of 550 rupees in the December quarter. But all that said and done, despite its higher AOV, Blinkit is still burning a lot of money. Its EBITDA loss went up to 178 crore rupees. And that brings me to the heart of the matter. Quick commerce is red hot right now, and the competition is making it very hard for any of these players to make money. Now, mind you, this is not about discount wars as such. It is actually about fighting for user attention and high margin categories. Blinkit CEO Albinder Dhinsa said that pressure on margins is very high because there are more players in the market now. And as a result, it is harder to charge higher delivery fees or push more profitable products. Swiggy CFO echoed the same sentiment as well. He said that competition is rising both from existing rivals and from new players which are trying to enter this space. Zepto, for example, is rapidly expanding with a target of 1,200 dark stores. Amazon and Flipkart are also testing their own quick commerce plays. So basically, this market, which once used to look like a 2-horse race, is very quickly getting very crowded. And then there's of course Reliance, which is playing a very different game here. See, unlike others, Reliance does not need to build new warehouses. It already has a massive retail footprint through its physical stores. So basically, they are using these very stores to deliver their orders. And that means that it does not really have to spend on new infrastructure, and that gives it a very, very clear and a very big cost advantage. In other words, this business is very incremental in some sense for them. Their fixed costs are already covered by store sales, so they only need to spend a little bit extra amount of money to fulfill online orders now, and that suddenly lets them run their business profitably, maybe from day one itself. So basically, in a world where everyone else is burning cash, Reliance could probably very quietly be making money in this business. Eternal also, by the way, is trying to play get very smart here. They recently shifted to becoming an Indian owned and controlled company, or IOCC. Now, I know that sounds a little bit technical, but what it basically means is that now, since it has majority Indian ownership, it can work around India's foreign direct investment or FDI restrictions. And as a result, Blinkit can now own its inventory, which is something foreign owned companies cannot easily do in this space. And that could be a very big advantage for them. Eternal claims that it would cost them just about 1,000 crore rupees to buy and hold all of Blinkit's inventory, which is at only about 5% of Blinkit's total net order value of 22,000 crore rupees in FY 2025. Now, that, mind you, is not a lot for a company of this size, and if it improves its margins by cutting out wholesalers or distributors, that is going to be a very big strategic win. Zepto, on the other hand, is also moving in a very similar direction. They recently raised money from Motilal Oswal, and they are actively working towards becoming IOCC compliant, although they haven't formally declared it yet. Swiggy, on the other hand, though, is still figuring all of this out. Their CFO said that the company's domestic ownership is going up and they may consider becoming IOCC in the future, but there are no concrete plans right now as we speak. So basically, it's fascinating how the battle for faster deliveries is also very, very quietly turning every player a little more Indian now. Also, by the way, on a very quick and final note, I wanted to tell you that these insights come directly from the earnings calls that these companies hold with investors. Now, I know the reality is that these calls can get very long and also a little bit dull, but the reality is also that they are full of useful nuggets if you pay attention to it. So therefore, if you are curious but you don't really want to listen to an hour-long call, you can check out our latest newsletter, which is called The Chatter. Basically, in this newsletter, we pull out all these interesting bits from these company updates and serve it to you in a newsletter and a readable format. But back to the story anyway, if I were to summarize, food delivery still makes money, but it is slowing down. Quick commerce is growing rapidly, but it is eating up a lot of cash. Swiggy, on one hand, is sort of going all in on Bolt and groceries. Eternal, on the other hand, is backing Blinkit, betting that owning its inventory and having a higher AOV will tilt the odds in its favor. The big question is whose bets will pay off, and will any of these actually become profitable at scale, or are we actually watching a giant expensive experiment in how to deliver things faster and faster? Of course, none of us have a clear answer yet, but what is for sure is that this is one of the most exciting stories in Indian business right now, and all of us will be watching it very, very closely. On that note, let's move on to the second story of the day. See, imagine living in a world where everything, right from your work files to your favorite shows, from your bank records to your dating apps, all of them suddenly vanish. No Google Docs, no Netflix, no Instagram, and no other apps as well. Even your Wi-Fi and your phone might actually stop working. Now, I know it sounds like a sci-fi movie disaster, right? But that's exactly what would happen if the global system of data centers, which is the physical backbone of our digital lives, were to suddenly disappear. The thing is, in our daily lives, it's very easy for all of us to get caught up in the shiny side of technology, which is artificial intelligence, fancy gadgets, smart assistants, and also the feeling that everything happens and is stored in the cloud. But that cloud, mind you, is not just some abstract thing floating in the air, obviously. It is real. It lives in massive warehouse-like buildings, which is filled with thousands of specialized computers that sort of never sleep. Now, these buildings are what we call data centers, and they are now very quickly becoming one of the most important pieces of infrastructure in the modern world. See, over the last few years, countries and companies around the world have been pouring billions of dollars into building more of these data centers. I'll give you an announcement. Microsoft said that they are putting in 500 billion US dollars into a thing called Project Stargate. The thing is, I know it sounds fake, but all of this is very real. And the reason is very simple. Almost everything that you and I do now, right from chatting with friends to even training AI models, all of it depends on data centers working very smoothly in the background. The question then is, what exactly is a data center and why is everyone trying to build so many of them? See, you can think of data centers as a giant high-security digital warehouse. Now, inside this, you will find endless rows of powerful machines which are called servers. Now, these servers are what actually store all of your emails, host all of your Zoom calls, remember your search history, run your favorite apps, and even keep social media apps alive. Every time you do something as simple as tapping a button on your phone, you are basically pinging one of these machines somewhere in the world. Also, when people talk about their business running on cloud, this is what they are referring to. That cloud is just a bunch of servers sitting in a physical data center somewhere in the world. Big tech companies like Amazon, Google, Microsoft, etc. make huge chunks of their revenue not by selling gadgets really, but actually by renting out data center space to other companies who then run their apps and services from there. Now see, measuring data centers can be quite tricky. But one very rough way to get a sense of how much capacity we have is by looking at the power that these centers consume. See, right now, the total global data center capacity stands at over 50 gigawatts, which is a number that is about to explode thanks to one powerful force, which is artificial intelligence. Now, AI, as you and I may already know, is already changing how we live and we work. But what many people do not realize is that AI also demands an enormous amount of computing power. These machines basically need to process huge amounts of data quickly, securely, and also reliably. And that is why nearly 20% of global data center capacity is already being used for AI related work. And this, mind you, is just the very beginning. If projections are true, the total global capacity could reach 100 gigawatts by as early as 2030. But that still may not be enough. McKinsey, for example, estimates that by the end of this decade, we may need anywhere between 171 to 298 gigawatts in order to meet growing demand, which is more than double the expected supply. And about 70% of this new demand will actually be driven by AI use cases alone, especially generative AI models like ChatGPT, Midjourney, Gemini, etc. And that brings me to the big question, which is what is India's role in all of this? Look, right now, India is still sort of finding its footing in the global data center race. We've only very recently crossed the 1 gigawatt mark in total capacity, which is a big milestone for us, but that is a very small fraction of what's happening globally. India is home to about 150 data centers, concentrated mostly in cities like Mumbai, Delhi, Chennai, and Bangalore. Now, some of these are owned by Indian giants like Reliance, Adani, and Tata, while some others are actually operated by global players like Amazon Web Services or AWS, Microsoft, and Google. But the catch here is that India currently generates about 20% of the world's data, but the problem is that we only host about 3% of our data center capacity. And to put this into some perspective for you, the US has 51 times more data center capacity per person than we do. So very clearly, there is a huge mismatch here, and that makes it all the more important for all of us to catch up to what's happening. See, there are two big reasons why growing our data center capacity is very important. First is better connectivity. See, the data you send or receive, whether it's a YouTube video or a message on WhatsApp, travels through a physical network and eventually reaches a server that is sitting in a data center. Now, the further the data has to travel, the more lag and delay you end up experiencing. And that is why having more data centers within our country in India can make the internet faster and also smoother for everyone here. It also makes it cheaper for companies because transferring data across borders usually comes with an added cost. Second, this gives us control over our own data. See, when data about Indian users is stored in foreign countries, it also starts to fall under the laws and rules of those countries and not in ours. Now, this might not matter when we're talking about meme videos, but it becomes very serious when we're talking about things like government records, financial information, health data, or anything that's sensitive to us or our country. Now, India's own data protection laws require certain categories of data to be stored within the country, and for good reason for sure. Other countries like China, the European Union, and South Korea have already in the past implemented very similar laws in order to ensure that their data stays within their own control. But now, all that said, we all need to know that we need more data centers for sure. But the question then is, what's really stopping us? See, building a data center is not as simple as putting up a building and plugging in some computers. The bigger part of the problem is that you need land and you need constant power and also a lot of it. You also need advanced cooling systems, high-speed fiber optic networks, and also proximity to places where there is strong and steady demand for digital services. Now, some countries and regions have figured out the exact right mix for this. In the US, a region near Washington, D.C., which is called Northern Virginia, has become the center of the data center universe. The advantage was that it had early internet infrastructure, cheap suburban land, and stable electricity, and it now houses over 300 data centers with over 4 gigawatts of capacity. Now, that, mind you, is more than all of India's capacity combined. If you talk about Europe, cities like Frankfurt, London, Amsterdam, and Paris have grown very rapidly thanks to strong demand, supportive local policies, and also excellent connectivity. And if we talk about closer to home in Asia, Singapore initially emerged as a leader thanks to its pro-business policies and also its location, but the problem was that rising costs and limited space has now pushed some investments into Malaysia and Indonesia as well. But continuing on Asia, China went very big. They built out massive data centers in remote western provinces and paired it with strict laws which forced companies to store data locally. But again, in the quest of scaling too fast, they now have a very big problem that nearly 80% of their new AI computing capacity is reportedly sitting unused with no real demand to match. The question then becomes, what can India really learn from all of this and implement? See, the good news is that we are not really starting from scratch. It is already 10 to 25% cheaper to build and operate data centers in India as compared to other places like, let's say, China or Singapore. Now, that of course is a big advantage, but we also face some very serious hurdles here. One, our approval systems are still way too slow and complex. See, while a few states like Maharashtra have simplified things with single window clearance systems, other states still make developers jump through multiple hoops in order to make things happen. The second point is that our electricity ecosystem is not just reliable enough yet. Data centers basically need to run non-stop 24/7. But in India, power cuts are very common in reality, and the efficiency of our power use, which is by the way measured through something called power usage effectiveness or PUE, is very, very poor as compared to global benchmarks. And this raises operating costs and lowers reliability. Third, we have environmental constraints as well. See, data centers use a shocking amount of water, which is sometimes as much as 7 million gallons per day just for the purpose of cooling. Now, in a country where we are already facing some serious water shortages in many regions, this becomes a very big problem. But all that said and done, there is still a reason to be optimistic. India's data consumption is absolutely exploding. Over the past 5 years, our average data usage has sort of doubled. And that means more apps, more streaming, more digital services, etc. And all of that requires stronger infrastructure. The market is also responding to it. India's data center industry is already generating over 1.2 billion US dollars in revenue and is growing at about 20% annually. To give you context, between 2019 and 2024, we attracted nearly 60 billion US dollars in data center investments. And if current plans go through, we could see another 100 billion dollars coming in by as early as 2027. And it's not just that, some of the biggest Indian players are also now figuring out workarounds to our energy bottlenecks. Reliance, for example, is building a gigawatt scale AI data center in Gujarat, which is powered by its own energy assets. Adani, on the other hand, is investing 50,000 crore rupees in a Mumbai-based data center cluster using captive power. And it's not just these two companies. Airtel is doubling its capacity by 2027, Microsoft is investing $3 billion over the next 2 years, and global firms like STT, GDC, and Coal DCS are backing multi-billion dollar projects across Indian cities. And it doesn't even end here. Even at the policy level, things are picking up quite a bit. In 2022, the Indian government gave data center infrastructure status, which makes it basically easier to get funding. A national data center policy is also in the works, which basically aims to create dedicated economic zones for data centers and possibly even classify them as essential services in order to guarantee priority access to power and water. So if I were to summarize all of this, the thing is that we are not really in the global top league yet, but we are definitely climbing up very slowly. With the right mix of policy, private sector ambition, and also problem solving, India could really position itself as a serious contender in the next chapter of global digital economy. There is of course undoubtedly a very, very long road ahead for us, but the thing is, if we play our cards right, we could really become the go-to destination for the world's AI and cloud infrastructure needs, and we can maybe turn today's disadvantage into tomorrow's advantage. That brings me to the end of the two stories of the day. With that, let's move on to the final section and talk about the quick news headlines. First, LTI Mindtree on Monday announced its largest ever deal worth $450 million with an undisclosed agri-business client. The 7-year agreement involves deploying an AI-powered operating model to deliver application management, infrastructure support, and cybersecurity services. Second, electric scooter maker Ather Energy reported a 29% year-over-year increase in revenue for Q4 of FY 2025, reaching 676 crore rupees compared to 523 crore rupees in the same period last year. The company narrowed its net loss to 234 crore rupees from 283 crore rupees. For the full year that ended in March 2025, Ather's revenues rose 28.5% to 2,255 crore rupees, while annual net loss reduced to 812.3 crore rupees from 1,059 crore rupees in FY 2024. Third and the final one for the day, iron ore futures in Singapore slid backwards towards $99 per ton, erasing gains from earlier this week when prices had risen over 3% to reach their highest close in nearly 3 weeks. The initial rally was triggered by a US-China trade truce that briefly lifted risk sentiment across global markets. That's all the news and stories I have for you today. I hope you enjoyed this show. This is your host Anurag Bansal signing off. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.